What if I told you that in 1998, 16 men almost destroyed the entire global economy? What if I told you these weren't criminals or reckless gamblers, but Nobel Prize winners, mathematical geniuses, and Wall Street legends? And what if I told you their failure teaches us more about success than any victory ever could? Welcome to Timeless English Talks, where we uncover the stories that shaped our world. If you're new here, hit that subscribe button right now because this story is going to blow your mind. This is the story of the smartest people in the room who thought they couldn't lose until they lost everything. Let's go back to 1994, Wall Street, the financial capital of the world. And in a sleek office in Greenwich, Connecticut, something extraordinary is being born. A hedge fund called Long-Term Capital Management, LTCM for short. But this isn't just any hedge fund. This is being called the dream team of finance. The founding partners read like a who's who of Wall Street royalty. Leading the team is John Meriwether, a legendary bond trader from Salomon Brothers who was known as one of the smartest minds on Wall Street. But he's not alone. He's recruited two Nobel Prize-winning economists, Myron Scholes and Robert Merton. These aren't just smart guys. These are men who literally wrote the mathematical formulas that modern finance is built on. The Black-Scholes model? Yeah, that's them. They mathematically proved how to price options and derivatives. They revolutionized finance. They won the Nobel Prize for it. And they're not done yet. The team includes PhDs from MIT, former vice chairman of the Federal Reserve, computer scientists, mathematicians. This is the most educated, most credentialed, most intellectually elite team ever assembled in finance. If there was ever a group of people who could beat the market, it's them. And here's what makes them different. They have a strategy, a mathematical strategy based on something called arbitrage. Now, let me explain this simply. Arbitrage is finding tiny price differences in the market and exploiting them. Imagine you notice that gold is selling for $1,000 an ounce in New York, but $1,001 in London. You buy it in New York, immediately sell it in London, and pocket the $1 difference. Risk-free profit. That's arbitrage. But the differences LTCM is finding are much smaller. We're talking fractions of a penny. Differences so small that most people wouldn't even notice them. But here's their genius. They use massive leverage. They borrow enormous amounts of money to make these tiny profits add up. If you make 0.1% profit, but you're trading with $100 billion, that's $100 million. And because their strategy is based on mathematical certainty, based on Nobel Prize-winning formulas, they believe the risk is minimal. They've calculated everything, modeled every scenario. They literally have PhD mathematicians running millions of computer simulations. What could go wrong? In their first year, 1994, LTCM returns 28% profit. Not bad. But in 1995, they return 43%. In 1996, 41%. These are insane returns. The best hedge funds in the world are happy with 15 or 20%. LTCM is doubling that, and they're doing it with what they claim is almost no risk. The investors are ecstatic. The minimum investment is $10 million, and people are lining up. Wealthy individuals, banks, even other hedge funds are begging to invest with LTCM. By 1997, LTCM is managing over $100 billion in positions. To put that in perspective, that's more than the GDP of many countries. They have leverage of about 25 to 1, meaning for every dollar of actual capital they have, they're trading with $25 of borrowed money. But the partners aren't worried. They're Nobel Prize winners. They've done the math. Their models say this is safe. But here's what they don't see coming. Here's what all their mathematical models, all their computer simulations, all their genius doesn't account for. The world doesn't always behave rationally. Markets aren't just numbers. They're made of people. And people panic. In the summer of 1998, everything starts to unravel. It begins halfway around the world, Russia. The Russian economy is in trouble. The government is running out of money. On August 17, 1998, Russia does the unthinkable. They default on their debt. They literally tell the world, we can't pay you back. Now, LTCM doesn't have huge direct exposure to Russia, but what happens next, nobody predicted. Panic spreads through global markets like wildfire. Investors around the world suddenly realize, if Russia can default, who else might default? What else might go wrong? And when people panic, they don't think rationally. They run. They sell everything risky and buy the safest assets they can find. U.S. Treasury bonds, cash, anything secure. And this creates a problem for LTCM. Remember, their strategy is based on tiny price differences that should converge. They're betting that Italian government bonds and German government bonds, which are almost identical in risk, should trade at almost the same price. But when panic hits, people stop caring about what should happen. They just want safety. So the prices that LTCM expected to move together start moving in opposite directions. The tiny differences they were exploiting, they're getting bigger, not smaller. At first, the partners aren't too worried. Markets overreact sometimes. Things will normalize. Their models say so. But then it gets worse, much worse. Other hedge funds are in trouble too, and when they start failing, they have to sell their positions, liquidate everything. And what are they selling? The exact same positions that LTCM holds. So now prices are moving even against LTCM. It's a death spiral. The more other funds sell, the more LTCM loses. And the more LTCM loses, the more their lenders start to worry. Remember, LTCM is leveraged 25-1. Small losses become catastrophic losses. By early September 1998, LTCM has lost 90% of their capital. 90%. Billions of dollars evaporated. But here's the truly terrifying part. LTCM owes money to almost every major bank on Wall Street. And not just Wall Street, banks in Europe, Asia, everywhere. They have over $1 trillion in derivatives positions. $1 trillion. If LTCM collapses, it won't just hurt them. It could trigger a cascade of failures across the entire global financial system. The partners are in denial at first. They're too smart to fail. Their models are too good. But the losses keep mounting. September 10th, 1998, John Merriweather makes a phone call. He calls the Federal Reserve Bank of New York, and he says something that sends shockwaves through the financial world. We need help. We're going to fail. And if we fail, we're taking the entire financial system down with us. The Federal Reserve springs into action, not because they care about LTCM, but because they realize the threat is real. If LTCM collapses, the panic could spread. Banks could fail. The stock market could crash. The entire global economy could freeze up. This isn't just a hedge fund problem anymore. This is a potential global catastrophe. The Fed brings together the heads of 14 major banks, Goldman Sachs, JP Morgan, Merrill Lynch, all the big names, and they deliver an ultimatum. You need to bail out LTCM, not because they deserve it, but because if you don't, you'll all go down together. Can you imagine the irony? These Nobel Prize winners, these mathematical geniuses who thought they had eliminated risk, now need to be rescued by the very system they thought they'd outsmarted. The banks agreed to inject $3.6 billion to take over LTCM and slowly unwind their positions. It's one of the largest financial rescues in history, and it works. Barely. The global financial system doesn't collapse. LTCM is quietly dismantled over the following months. The partners, who were billionaires on paper just months earlier, lose almost everything. But here's what makes this story so important. Here's why you need to hear this. LTCM failed not because they were stupid. They failed because they were too smart. They had so much confidence in their models, in their intelligence, in their mathematical certainty, that they ignored the one thing their models couldn't predict: human behavior. They forgot that markets are made of people, and people panic. People make emotional decisions. People do things that don't make mathematical sense. The LTCM partners believed they had found a way to eliminate risk through pure intelligence, through better math, better models, better analysis. But what they really did was hide the risk. They made it invisible until it wasn't, until it exploded in their faces. And here's the lesson for all of us. Confidence is good. Preparation is good. Intelligence is good.
But overconfidence is deadly. Thinking you've figured it all out, that you've eliminated uncertainty, that you're too smart to fail, that's when you're most vulnerable. How many times have you seen this pattern? The straight-A student who never learned to handle failure, the athlete who was always the best until they weren't, the business that dominated for years and then collapsed because they couldn't adapt, the relationship that seemed perfect until it suddenly wasn't. We all want certainty. We all want to believe we have it figured out. But the world doesn't work that way. The world is complex, chaotic, unpredictable. And the moment you think you've mastered it, the moment you stop respecting uncertainty, that's when it comes for you. The partners of LTCM learned this the hard way. They had Nobel Prizes. They had PhDs from the best universities in the world. They had decades of experience, and they still